Peter Cardillo, he's Chief Market Economist at Spartan Capital, joins us on the phone line from New York. Peter, good evening to you. Thanks for joining in. Somebody did an analysis, which I saw on social media, that of all of the last meetings that the Fed has done, it has rarely surprised. This meeting or the outcome or the commentary surprised you one bit?
No, not at all. I didn't think they were going to raise rates. There was one little surprise, I should say, and that is the fact that they basically indicated that perhaps in 2020 there'll be no rate hike. But of course, all of that is predicated on whether or not inflation should begin to pick up. And I think the Fed chief was quite humiliated by the fact that so far.
I think we just seem to have lost Peter Cardillo. We'll try and repatch that line as well. Keep in mind, a lot of focus about what the dot plot indicates as well. Now, the Fed, after having cut rates 3 times in 2019, has suggested there will be a prolonged pause in all likelihood for all of 2020. But keep in mind, the market is expecting a funds rate of 1.32% by the end of 2020, which would essentially mean one more cut versus the projection of 1.625% from the Fed, which is no more cuts. The only question is which way the Fed will go. But I think we got Peter back. Peter, sorry, you were finishing your point. The line got disconnected.
Yes, I was saying until we see inflation, it appears that the Fed is going to stay on hold. Now, of course, inflation can flare up. And, of course, if the job market continues to stay tight and all of a sudden we see a pickup in global economic activity and we should see a price in, let's say, crude oil prices, then I think, that changes the outlook of the Fed. But for now, the Fed is basically somewhat puzzled over the fact that there is no inflation. And so until we see inflation, it appears that the Fed is not going to move.
Yeah, that also, well, if I read a lot of if I believe a lot of reports that are written, Peter, not just for the US, but for a lot of major economies at large, inflation might find it hard to make a meaningful comeback. So why is it that the market seems to be believing that there might be one more cut versus the Fed saying that there is going to likely be a prolonged pause?
Well, I think, it all depends on whether or not we get a quick resolution or at least begin to see some sort of progress on the trade talks with China. If we get some sort of relief in tariffs and, of course, some more goodwill gestures and finally some agreement in 2000 that is a meaningful agreement, then I think, that changes the whole picture. And in fact, some of the risk factors were basically missing from the Fed statement. And it appears that the Fed now seems to think that there will be some sort of a resolution, although obviously it remains somewhat of a risk. And so I think if we don't get a resolution to the trade war, then, of course, that ups the possibility of the Fed cutting one more time. But if there should be any positive movement, I just can't see how we can have growth at 2.25%, maybe even 2.5%, and have the Fed funds rate down to 1.5, 1.7. That would be quite risky in terms of accelerating inflation.
Peter, just one more thing. Never mind what Donald Trump may believe, the Fed, at least in its commentary, has said that they would not be shy of helping out the market should the need be. Do you reckon that unless something changes meaningfully, and again on the trade front as well, as most people say that there might be a tariff deal and not necessarily a trade deal until maybe even after elections in the US, do you reckon the Fed would be nimble enough to do that? And for now might be on pause, but if the situation demands, they might go ahead and tinker with the rates as well.
Well, It's hard to say. I mean, I don't think that a trade deal certainly would relieve the pressures on the global economy, and probably it would boost economic growth here in the States close to maybe 2.25%, 2.5%. And so again, one of the strongholds of inflation being somewhat muted is the strong dollar. And I believe that if we get movement on the trade deal, that the dollar probably could weaken somewhat. And if that happens, and of course the risk of inflation moving up a bit could be a real possibility. Now, of course, we would need sustained inflation, and we would need inflation that would really have to surpass the Fed target for the Fed to be worried. So, for now, that's not a concern. But I think a lot depends, as I said before, on the outcome of the trade war.
Okay, Peter, we'll leave it at that. Thanks much for taking the time out and being with us.